Hey guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So you're trying to buy that condo. So let me tell you something. Here's something that majority of people don't tell you. Tell you. Condo loans are more expensive. Not only are they more expensive, they're a bigger pain in the ass. So a couple of the problems, and what I'm going to do is stay tuned. I'm going to go ahead and do a live pricing where, you do the screen on screen thing. You can see exactly what I'm doing on my computer. You can see how the pricing is, the breakdown and all that stuff on the mortgage broker side. The big kahuna, the guy that gives you the money for these things. So what we have, whenever you're buying a condo, you're going to come across a couple of hiccups. Number one is going to be, HOA sometimes is a pain in the ass to get a hold of, which is not a problem. But the problem is that when we contact HOA and we put in an offer, depending on what loan program you get, there's something that's called warrantable condos and non-warrantable condos. There's a few stipulations that go along with warrantable and non-warrantable condos. Warrantable condos are stuff that you're allowed to go ahead and do. Your real estate agent, your real estate broker, whoever is doing the transaction for you should already know this. They should already have this all dialed in. The listing agent should already have this dialed in. And if they don't, they suck. They don't know what they're doing. Please, for the love of God, save yourself your time, your money, and go find somebody who's experienced enough to go ahead and make sure you don't lose out on your EMD. Make sure that the people aren't pissed. Nobody's wasting their time. I swear to God, it's going to make everybody's life easier. But in case they don't know, at least you're watching this video so you kind of get to know. So as far as FHA goes, FHA, conventional, to make a community non-warrantable, there's a couple of things. Now, if one entity owns more than 10% of the whole entire community, because condos are they're pretty much condos or apartments, right? That's all condos are. Condos are apartments just buttered up into a different name, condominium, right? So if one entity owns more than 10% of the whole entire community, that becomes non-warrantable, and that is because, and the reason why they actually call it a warrantable and non-warrantable is because it puts HOA, the homeowners association, in kind of an unfavorable position, which not warrants them to be as effective as typically they would want to be. Because HOA, a homeowners association, all it is just a bunch of people who collect money off of, it's lawyers that know what they're doing. They're HOA sucks, by the way. HOA, I mean, if you get a bad one, HOA is such a pain in the ass. They're so bad. But number two is if 50% of the community is rented out. Because what happens is then the homeowners association has a list of every single condo that has been rented out, and then since they're rented out, they go ahead and send it on over with the questionnaire that we go ahead and send it out. And when we send out the questionnaire, hey, there's more than 50% of the community rented out, and they say yes it is, then that will make it non-warrantable, and that will not fall under FHA conventional. Now, this is June 2022, things could change, guidelines always change, so don't hold me to this. Everything is always up and down. But for the most part, that will mean that it's non-warrantable. There's other stipulations too, like let's say the homeowners association is in litigation with somebody, they're being sued, and if they're being sued, that means they're not warrantable. If they don't have enough in their reserves and they have to go ahead and, something is about to happen with the HOA because they didn't do their due diligence by holding up to the CC&R. A CC&R is your conditions, covenants, and restrictions. And if they don't come to the terms that everybody agreed to, then they could get in trouble. So there's a bunch of things that you could go ahead and get in trouble with your HOA, but make sure your real estate agent knows. The main things is make sure you ask the specific question. Hey, before we put in this offer, is this a warrantable condo or a non-warrantable condo? Because once you put that earnest money deposit in and then you go into contract and the offer gets accepted and you find out it's non-warrantable because your real estate agent or broker didn't do what the hell they were supposed to do, that kind of makes it a shitty situation. But what we're going to do is let's go ahead and price out a condo loan so you could actually see how much you're going to be paying. And for the sake of this argument, I am going to do it for $500,000. And if you want to go ahead and see how much it would cost, link below, aldenmortgage.org. That's my company. That's me. That's my website. I have calculators that are set up for you guys so you could do whatever the hell it is that your little heart desires. And you could see exactly how much it's going to go ahead and cost you. But Actually, what I'll do is I'll go from single family, or I'll go condo, and right after condo, I'll show you how it is on a single family. But let's go ahead and check this out. How'd you guys like that? Did you like my little security login thing? All right, so let's get on with this guy. Give me a minute. Shut up. All right, now let me get into the recording. All right, let's record. Here we go. Are we recording? And here we go. So this is going to be your drag and drop file. I'm not going to go ahead and bore you with a lot of this stuff. We're going to go ahead and do a 740 credit score because, well, hell, that's what I'm doing. So this is the company. I'm actually my own company. I'll actually be the loan officer on this. We actually use another program, which I've said in many videos, but we use another program called LendingPad. It's just, it's too much personal information that I can't get around it. So I had to go ahead and delete the cookies on this, and we're just gonna go ahead and do this dummy file here. So for the sake of this argument, we already have some things over here pre-populated. 480,000 would be at 96%. We'll do a couple. Let's go ahead and do one at 80% loan to value, which just means 20% down, which is $100,000, excluding your closing costs and all that other good pajazz. But let's go ahead and go. This is going to be your primary residence. We are going to go ahead and go to condominium. We're going to go ahead and go attached, because there are two. There's attached and detached. You know, let's get out of this. We're going to go ahead and do a 740. You know what? Let's just do 800 credit score or whatever. Doesn't really make a difference right now. And if you guys want, you could see I have another video, which I'll link somewhere above here. Go to FHA, the battle of the 3.5%. I did a video so you could see exactly what the difference is in price from a 640 credit score, 700 credit score, and an 800 credit score. So for the sake of argument, we're just going to go ahead and do the monthly income at $10,000. Monthly debt is $1,000. Taxes are going to be $8,000 annual. Homeowners insurance, I don't know, we'll do $1,200. Finance charges, none. We're going to go ahead and do a 30-day lock. Now, whenever you are in the world of mortgaging, when you're in the process of purchasing your house, the lock period is the most extreme. It's so extremely important. This is our thing because we have to close everything by this date. That doesn't mean that all the paperwork has to be done by this time. It actually has to be done 4 days before this because we have to go ahead and send out the CD, have you sign, get a wet signature, and then from that day, then we have 4 days that we have to go ahead and wait until it gets funded. So this is very, very, very important. It doesn't take 30 days to go ahead and close the loan. And actually, we have to have everything closed, done, all your verifications done before that. But 30-day lock. We're going to go ahead and do borrower paid because I don't want you guys to see how much I get. Lender paid is like this pre-negotiated rate that I have with the wholesaler, and then borrower paid. But this does not mean that it's a bad thing. If you see how much I get paid, if you see how much origination charges are, it doesn't mean that it's a bad thing because you get a credit, and I'll show you here in a little bit. Like let's say I make $5,000 on this loan, right? Hypothetically, let's just say 5, 6, 7, 8, 10,000, whatever the number is, right? If I made $10,000 off of this loan, would you rather not see that I made $10,000 on this loan, or would you rather see I made $4,000 or $5,000 off of this loan? So it's like don't be afraid of seeing how much origination charges, because this is how we end up competing with other other big banks or other brokerages or credit unions or whoever it is, because what we do is we take our compensation and we'll lower this so we could go ahead and get you guys all dialed in and beat the rate that you have currently with whoever you have. So we're not going to waive anything. We're going to go ahead and we're not going to do a first-time buyer or any of that stuff. So let's go ahead and see. Let's get our quote and give it a second. It's thinking. And for the sake of this argument, I also put California and blah, blah, blah. So so these right here are your adjustable rate mortgages. This is a 5, 6, 7, 6. Now, typically it's a lot less. This is less on non-condominiums, like a single family residence. But as of right now, we're going to go right over here. It's going to be at zero cost. You get paid, you don't have to pay any money out of pocket in addition to, no points charged to this, and that is going to be at 5.423 as of June 2022. Now this is without origination charges. This will adjust with origination charges. But yeah, that's where you're at if you want to go ahead and take a higher rate because you want to. So if you ever like want to take some money out because you don't want to pay some of the closing costs, what you could do is you could just jump up to like this, 6.5%, which is pretty drastic. I mean, it's not that bad, right? It's 52, 25, 28, 27. And then over here, we're at 2271. But it'll get $9,000, which this will eventually, this will just cover your closing costs for the most part, your title escrow. Not your prepaids, though. If you want to go ahead and do prepaids too, you're going to have to go ahead and bring some extra skin in the game. But what is the most? So the most you'll get back is 10,444. And the most you'll get, the lowest rate you could get, which was very common, which will cost you $34,456. That'll get you at 3.5. So it's still, you can still get at a 3.5%, but this is also excluding origination charges, title escrow, and everything. So assume that this will be somewhere around $50,000, give or take. But yeah, now let's go ahead and go back up to here, and we are going to go ahead and switch this out from a condo to a single family. And I swear to God, if parameters have changed and I look like an idiot right now, I am going to be so upset that prices stayed exactly the same. That'll defeat the purpose of this video. I will feel so stupid. I don't think I'm going to feel stupid, but let's see where it's going to be at. Oh, perfect. Yeah, so as you can see, bingo bango, I was not wrong. Thank you, Jesus, I was not wrong. That no cost, you are going to be at 5.122%. That is without registration charges. This is did I put detached? California, primary residence. Okay, that didn't come out. So everything else stays the same. 30-year fixed. Borrower paid, yes. So as you can see, there is a huge difference between a condo, an attached condo, and pricing versus a single-family residence. There's just more of a risk involved with condominiums, and that's why. And a lot of people don't understand. Like, oh, I love condos. I'm gonna go ahead and do a condo. And then, like, long story short, it ends up being way more expensive. And they're like, what the hell? I thought it was supposed to be cheaper, and it actually isn't. So in actuality, if you were going to be at the 5.44%, you could actually increase the total price range that you're at and then get something different. Of course, that's going to affect the down payment and all that other stuff, but this is just more for informational purposes. I just want you guys to see the difference between the price difference, the interest rate difference right here, the interest rate difference from a primary residence, single family residence, to a condo. So we're at 5.122. We're going to go ahead and go here. We're going to go to attach, and then just to double down on this, 5.122 versus, come on, baby, 5.22 to 5.423, and these are both going to be at zero cost to you. So that is how much it's running. I hope that this helped out. I'll go more in depth with condos. If you have any questions, you know what? Just go ahead and let me go ahead and stop the recording on this. All right. So the main let me make sure I'm in frame here. Okay, so the main purpose of this video is just to show you that there is a price difference between a single family residence and a condo. If you're buying a condo, you are gonna have way more costs associated with it, that's why it deters a lot of people after you find out the whole kit and caboodle about, you know, condos versus single family residence. HOA is a pain in the ass, interest rates are going to be higher, you have neighbors that you really don't want to be unless it's detached, but still you're so close to it, or a planned unit development, you're so close to other neighbors that it really, you're not really buying a home, you're just buying something that's kind of like an apartment. But hopefully this helped you out. for up to 50% commission rebate here in the state of California. 0% listing on selling your current home or any of the mortgaging products that I have to offer here, from adjustable rate mortgages to bank statements to DSCRs to foreign national to hard money to I don't care what kind of loan it is. I got you because, well, interest rates have gone up really, really, really high and I'm bored. So until next video, guys, please consider liking, subscribing, all that good stuff. Until next video, guys.